Yeah, so you can see my screen, I suppose.
Yes.
Yeah, so welcome everybody to the Sit Chat. It's a program which we have been doing for more than a year now, every Thursday, without fail. That's been our, what should I say, record. Without fail for more than a year now, every Thursday at 8:30. Using this Zoom meeting ID, anybody can join. This is basically a knowledge sharing session with the purpose of discussing topics which of interest to startups and startup investors, startup mentors, startup founders, and startup employees on various topics. It could be about maintaining financial discipline, investments, marketing strategy, finding the potential investors, identifying the target market, or even talking about trying to find the ideal places to invest. And today we have that as the main topic. Before we go there, let me just give a small caution. See, we have always vetted the experts who come here on the Sit Chat, the guests who come here on the Sit Chat. They share from their wisdom, their experiences. However, we strongly recommend that you consult your trusted advisors and mentors, so that when you implement the insights that you get generated from this chat, you would not face a problem. You will have some kind of a expert to lean back on. With that, let me introduce the topic for the day. It's about understanding the world of angel investing. And this topic would be presented by Tushar. So let me directly hand over to him before much, what should I say, detail from my side. Before I hand over, a brief introduction about myself. My name is Dinakar. I am a mentor and a coach to companies. I help companies grow, improve their performance and grow using a methodology called as doHow. That's what you see in the back end. That's the methodology which I have created. And I use this, been using it for the last 12 years now. And earlier to this, I was working with Bosch in various roles and left Bosch in 2012 with the dream of trying to create world-class companies and exceptional leaders in India. With that brief introduction, over to you, Tushar. Please take over, and then you can introduce yourself a little more. And then after that, share your presentation. Then we have a short Q&A. Please go on.
Sounds good. Thank you. Thank you very much. Thank you for having me here. I'm Tushar Gandotra. I'm based out of Gurgaon. Have been into business for around 11 and a half years now. Before that, I was working for a software company as a business analyst. So it's somewhere around 2 decades of professional experience. I'm also a founder of an angel network, which is specific for Jammu Kashmir. So Jammu Kashmir Angel Network. Plus, I run my own venture studio. So these are a couple of things which I have been doing. The agenda of this conversation is primarily regarding the angel investments, on how it works, how it happens. And I have a presentation. So this presentation has been created by our partners and us. So we use this presentation for some different sessions which are specific, but we have made some changes to the presentation so that it's workable for everybody. So let's start with what is angel investing. If you have any questions, you can feel free to stop me, ask me, and we can have impromptu discussions. So what is an angel investor? Like a fairy godmother angel, so somebody who has some powers, and there is a person who's planning to build something or planning to do something. He needs something, so somebody comes as an angel. They give them money, that okay, use the money, build something, and then I'll take a share. So that is why it is called angel, that somebody helps you build your dream, but everybody has their own perception of what angel investing is. So when you say I'm an angel investor, your friends think though he is going on yacht parties, he's investing into different companies. He's just like in different parties, in fashion parties, blah, blah, blah. But nobody understands. Your mom thinks, oh, he's on the documentation, he's always on laptop, we don't know what he is doing, but he is an angel investor. Society thinks, everybody else think, okay, if you are an angel investor, you have a lot money, you just want to throw it to everybody so that they make something out of it. Entrepreneurs think mostly that, okay, these are the people who usually play golf, They go for very hardcore business meetings. They go for brunch dates, breakfast morning meetings. So everybody has their own perception. Uh, we think we are supporting companies from their journey when they start. Not just we, most of the angels, they have some mindset of supporting some interesting entrepreneurs and making some dough out of it. But in actual, it is mostly about a lot of meetings. So you meet the founders, you understand the concept, you meet clients, you go to conferences, you try to figure out some good deal flows for yourself. The whole idea is to find the right companies to invest in, and that's a tedious effort. I mean, that's not that simple. So generating a deal flow, everybody is ready to take money, but for an investor, there is always a limited fund. So where do you invest? Uh, Most of us know what are the usual stages of a startup. Uh, Most of the retail investors think that IPO is the time to invest. But mostly what happens is startup and starts, you get a better share for the money invested. So if the company reaches IPO, you have a huge profit already made before the company going public. So there are so many stages of investment, starting from pre-seed, seed. Mostly these are covered by angel investors, then usually the VCs, then usually the PE. So every stage has a different target of investors who will invest. There are very limited number of VCs who invest in pre-seed, but if you want to figure out what company is investing into what stage, the best idea is to go to their website. All these companies have their thesis on the website. Are we pre-seed investors? Are we seed investors? Are we Series A investors? Or are we pre-IPO investors? So they have their definitions on where they invest. So if you, as an entrepreneur, you don't reach the right VC or the right category of investor for your particular stage, you will not get a yes. So the idea is to have a proper mapping of the stage the entrepreneur is raising funds for and the kind of investors who invest into those companies. Now, when it comes to an angel investor making money, usually the return is driven by either dividend in the long run or exits. So exit happen when either some bigger investor comes into picture, they want to buy shares and you can sell. Sometimes what happens is a big company acquires the smaller company, so you get paid for the shares you own in the company. Companies goes public, you get the share, whatever the share you own of the company, you have that, you can liquidate in the market and get your money out of it. uh, Companies pay dividend, and there are secondary sales, so you can always sell your share to somebody else at a discount if you want liquidity, but these are highly illiquid investments. Usually there is a government defined lock-in period, but as startups, they usually, as a basic number, they usually want to keep the funds locked for, let's say, 3 years so that everybody has skin in the game. Here is an example of an angel investor who invested, let's say, 10 lakh rupees in Zomato when it started, compared to the time it went public. So the whole journey, if you see, if you invested 10 lakhs, by the end you got somewhere around 180 crores. That's 1880x. This is the kind of returns which you don't get everywhere. But with these kind of returns comes the risk of company going down. So, I mean, it's always a risky game. These things are all defined by the SEBI, and they tell everybody that in angel investing is a high risk, high reward game. So you might lose all the money you are investing as an angel investor. So you have to be very sure. You have to know what your risks are. Uh, that's mostly government has defined everything. We'll come to that later. So this is how the flow happens when it comes to money changing hands. So there is a startup, it usually pitches to angel investors when they are in the very early stage. If an angel investor agrees, they create a formal term sheet. Now, these term sheets are non-binding. So you cannot hold them in court that this was the term sheet and they went back on it. You cannot do that because all these term sheets are non-binding. So term sheet is basically initial step of saying that okay, we are interested. It's like an LOI. It's like you define all the things in the term sheet that this is how it happens. It's going to happen. These are our terms. These are your terms. This is how we'll work around it. And there are always negotiations. I mean, depends upon what is the kind of investment, what company is raising the investment. It's always open for negotiations and discussions, but the process is this. Once you have the term sheet signed, then comes to all the documentation. There is a lot of compliance work when it comes to money coming to the company. You recently heard about angel tax being abolished. All these are compliances by SEBI. If you are doing that, you need to have the right documentation, right taxes, right filings for the compliances and secretarial work. So a lot of things are basically on the documentation side. If you don't do that, it always is a challenge later. This screen is basically the government's definition. All right. So everything here is how government define angel investing through AIF. Now, what is an AIF? AIF is a regulated instrument by SEBI, which is called alternate investment funds. There are different types of alternate investment funds by SEBI. The one particular which I'm talking about is the category one angel fund. So it's an AIF category one angel fund. So this is usually a safe way of investing. Uh, Usually what happens is when you want to invest as an individual in a company, there are different compliances. But what happens is your check size is small, your negotiation ability is low, you don't get a lot of things, and you have to do everything by yourself. You have to vet the company, you have to do the due diligence, or you have to pay somebody for the due diligence. So all the onus basically lies on you when you are investing individually in a company without any SPV. But when an SPV comes into picture, SEBI has its own definitions and compliances for it. So SEBI says if you want to invest through an AIF, which is a more safe way of investing, you have to invest at least 25 lakhs over the period of 5 years. This money can go to zero. So even for that, SEBI has a check that your net worth should be at least 2 crores minus your residential house. So the house where you are living in, that should not be included. Except for that, your net worth should be at least 2 crores. These are more guidelines to ensure that if you have, let's say, only 25 lakhs and you lost all the money, you will not go bankrupt. So because it's a high risk, high reward game, so there is a bright possibility that your money will go to zero. So there are checks by the government to ensure the investor doesn't lose everything just by some foolish investment. So investor, whenever it comes to investing from the fund, investor consent is very important. So for example, there is a tobacco company, or let's say there is a alcohol brand. A group of people have collated their money to be invested into startups. But let's say I don't want to invest money into an alcohol related brand due to religious reasons. So I have the power to say no, that I don't want to invest money into it. So these are all things where you still have the right to say no or yes when it comes to investing. But when there is a commitment, you will have to commit in some other company for in the next 5 years. So commitment stays, but you don't have to invest in all the companies where the fund is investing. You can always choose to say no. Government says there is a minimum lock-in of 1 year. But usually when the documents are signed, usually go somewhere around 3 years, that there will be a lock-in of 3 years. All these are negotiable terms based on how an investor negotiates themselves, the deal with the entrepreneur. Uh, from an angel fund, a minimum check will be of 25 lakhs to any company where it goes. So, for example, there are 5 people who want to invest. There are two 25 lakh figures. You don't have to confuse both of them. These both are separate figures that you have to invest your own 25 lakhs in the company over the next 5 years. And if the fund is investing into a startup, it has to be 25 lakhs as well. So these are two separate figures. You have to understand that any company will be taking at least 25 lakhs of investment. And if you want to invest in a fund, you cannot have more than 25% share of the corpus or a maximum of 10 crores. These are definitions by the government when it comes to alternate investment fund of category 1 angel fund. All right. Uh, Government selects a watchdog. This you can see Bitcoin credential. That's a watchdog which basically keeps an eye on the angel fund. So they know that the money is not going here and there. They know everything is correct. Yes, Abhishek. I'm glad somebody is asking question now. Please go ahead.
Hi, Tushar. Abhishek here. So I have one question, which
Yes.
is, so let's say I want to invest 25 lakhs over a period of 5 years. Essentially, this is like a mutual fund, from what I understand, right? Like usually, like an
You can
AIF is
say
sort of like a
so.
mutual fund.
And the good thing is it's tracked in the same way. So now government, I mean, the fintech has some things where you can always see the company investment into your demat account. So it's
Okay,
treated as that.
okay.
You
So
get
let's
the units of the fund. It's the same way of mutual fund. Mutual fund is of different investment category, just a different investment category, but behaves the same way.
Okay. So let's say I invest 25 lakhs. Let's say it's upfront, right? Let's say it's upfront. Let's say my total over a course of 5 years, I'll probably invest about a crore or
Good.
so, right? Now, that money that I've given to the AIF will, the fund manager is going to handle the allocation into which startups it goes into and how much and what, right? Like you have no control on that essentially. That's how, like, essentially like how a mutual fund
Uh,
works.
that be somewhere or the other. I mean, you can always say no to an investment. So, as a fund manager, I have to take consent of all the investors. All right. I have to ask each investor that these are the investment which you are doing. You can choose to say no. So, see, understand this. Let's say there are 100 people pooling in 25 lakhs each. Now, there is a
Okay.
bigger fund, but you are not investing, let's say, more than 1 crore to a company. So, you are always investing a small portion of the total fund.
Right.
So that portion will be collated by the investors who said yes.
Okay. Got it. Got it. So it's not as straightforward as a mutual fund in terms of the
It's not.
actual functioning.
It's not.
Okay.
Yeah, there are certain changes. Mutual fund behave differently. The process is totally different. But in some ways, the thought behind it is the same.
It's sort of similar. Okay.
Different
And what about
category, different compliances, basically.
got it. What about redemption? So let's say, for example, let's say I invested in this AIF, which is then invested in, let's say, 10 companies, 10 portfolio companies. And let's say 2 years down the line or 3 years down the line, based on some news or personal insights or whatever it may be, or market insights, I feel, you know what, these three companies, depending on the categories they are, I don't think I want to stay invested. I want to close these positions, either get my money back or maybe reinvest in something else. Can I do that in an AIF?
So basically, you have to do a secondary sale. All right. You cannot do it directly unless there is an exit. All right. So if let's say there is an exit, the money will be distributed to the investors based on the agreements. There will be a fees, there will be a carry, but whatever profit is there, it has to be distributed among all the investors. So if
Okay.
you individually want to sell something, that's basically a secondary sale you can do. So that's individual basis. So you can talk to your AIF manager that I want to do a secondary sale. Somebody else can take over your shares at a discounted price. So they get a higher share at a better value. So you can
Got
always
it.
do a secondary sale.
But the AIF essentially facilitates the sale of my shares, the
It can
secondary
always happen. It
sale.
can always happen.
Okay,
That's not a
got
difficult.
it. Okay, perfect. Thank you so much. Please go ahead.
Sure. All right. So when it comes to the early stage of investment, when you do, so company basically, whenever company starts growing, starts generating sales, they create a lot of data for themselves. There are invoices, there are partners, there are so many things to verify. So when it comes to due diligence, you verify everything. But when it comes to a pre-seed company which has just started with an idea, they don't have that much data to prove how profitable they will be. They are mostly projections, but not the current or the past data. So you usually think about how and why you should invest in a company. Uh, these are all strategies you choose, a very individualistic approach, but what most of the AIF or what most of the investors, they create their own thesis that, okay, I'll see these five things in the team. Let's say there should be three team members or five team members, or let's say this idea should be validated in the market. So you can always create your own thesis on why and how or why I will invest money into a company. So be it a unique idea, let's say this company, you feel, let's say there is an agriculture product and you belong to the field. You see that product and you say, okay, this product has a huge potential, which I believe. So do I think this, the entrepreneur has the capability of exploring this idea? Because you are not the entrepreneur, you are the investor. So your money is basically riding on the jockey. So you have to understand, is the person talented enough to build what he's promising? All these factors are basically, you as an individual investor or as an angel investor, you have to create your own thesis why I should be investing in a company. It's a good learning experience. You get to know a lot of things and what's happening in the current companies. You have to understand how this industry is growing, how, so all these fund managers, usually these are the people who are doing research on how the industry is growing, what are the expected return multiple, how these things are happening. But you have to always work along with the entrepreneur to figure your own thesis why you should invest. A fantastic entrepreneur who is, let's say, an IIT IIM pass out, you know, he is super energetic, he is super charismatic, he is going to break a lot of walls and move forward. So it's a good opportunity to invest. Let me do that. You can take a small risk. So all these are a part of your thesis on how you create. Already discussed. So either you invest as an individual into a company, uh, everything is on you. The onus of protecting yourself is basically on you. You have to figure out the due diligence. You have to speak to everybody. You have to speak to the clients, and you have to spend your own money. So, for example, you ask somebody that, okay, there is a company I want to invest in. They have to do, I want to do due diligence for it. And that company will say, okay, we'll charge 2 lakh rupees for the due diligence. We'll go through all the documentation. We'll understand if this is a fit investment for you or not. So you pay those things individually. But when it comes to a fund, these costs are shared. So we'll do, so let's say we have a group of 100 people. The due diligence cost is divided among 100 people. So it's not a huge number, but you can do the same things with the company. Risk is, I mean, the onus is not on you to take the decision. There is set of people who are working on it, continuously researching on if there should be a valid opportunity or not. All the investment space, uh, if you are like an average person like me, 80-20 is the ratio where everybody finds a good balance, that 80% of the portfolio companies will fail, 20%. So let's say there are 20 companies, uh, 10 companies will directly go close. So you will not get any single penny back. 5 companies will be probably on a plateau. They have been generating revenue, but you are not getting your exit multiple. And let's say 2 companies will be outliers. They are going to make a lot of money. So all these, when it comes to a fund or a syndicate, these are all balanced. So you have a balanced portfolio. The performance of the portfolio is dependent upon multiple companies, just like an index fund or a mutual fund, that you are not focused on only one company. You have a bag full of companies to hedge your risk. Uh, you do your own negotiations the same. Uh, Paperwork is very important. You have to know what are the paper required on the commercial side and what are the documentation required on the professional side. So compliances, uh, taxes, share certificate, so many things are there are so many compliance things which has to be done. So these are main things on I think there's another slide. So paperwork usually includes you on the company side that you need to have the term sheet. You look at the share subscription agreement, you create the share purchase agreement, business transfer agreement wherever is required, if in case you are taking a bigger share, uh, shareholder agreement, so many agreements. So, so these the other agreements, which is like the ESOP policy, employee retention, these are good to have. So if a company has all these things, there is a clear picture in front of the investor on what is happening in the long run. So if you know there is, let's say, a 7% of the total company share is going to ESOPs, it has to be documented. All these things have to be done. When you are investing, and let's say the company has an IP but they don't have the IP rights or they have not filed it, you need to see are they properly filed or not. So if they are talking about some particular IP and they don't have it filed, then it's not the right value. So the money you are investing might go to might fail. So all these things are important when it comes to investing your money, and this is your money, so you have to be sure of everything when it comes to investing. Everybody's taking risk. This is a riskier game. If you don't do your documentation, challenges, eventually there will be problems, court. So you will tell the entrepreneur that, okay, this is not what I wanted, I want to exit. He'll say, no, you cannot. Go to court, do arbitration. So many documents you have to go through. So these things have to be kept simple, and these are done basically by the involvement of some professional. Uh, I personally don't recommend anybody to do everything by themselves. It's not the right approach. Eventually, so I have done it myself. I have lost some good amount of money into startups. I did it myself by doing my own due diligence, investing into a few companies, and I lost all the money. So that is where my journey started. I tried to understand what is a better way of investment. How can we have a balanced portfolio? That is how my journey started, and I'm still learning. All these things are basically jargons of the industry: tag along rights, drag along rights, MSOP, ESOP, earnout, liquidation preference, non-compete. All these things go into the agreements when you do your investment. So you need to know what is happening. Tag along right is that if you are going for the next investment, we want to be a part of it. You have to ask us first that do we want to invest more or not. uh, all these things are technical jargons, very focused on when it comes to your future rights. So if all these things are properly logged on a document, you will not have any problem. I remember recently there was a case with Baiju with their anti-dilution rights. So some investor came into picture that said that you cannot dilute these things. So they wanted to liquidate some more assets. I remember something like that. So if you have an anti-dilution rights or the vesting for an entrepreneur or the investor, so all these things have to be checked, tick marked, or crossed if you are doing your investments. I think I am at the end of my presentation. Uh, let's take up the questions now. We still have around 20 minutes. So any questions you have, I would be happy to answer. I think yes. That's pretty much my presentation.
So, Tushar, thanks a lot. Thank you so much. It was really very informative, extremely engrossed in whatever you said. See, I
Thank
have
you.
a couple of questions to start with. See, as an angel investor, though I like you mentioned about your own personal experience. Uh, what is it that one would look for in a company? What is it that uh, that is common in this 20%, not the 80%, 20%? What do you look for to make sure that you are investing in the
Mostly,
20%?
mostly the entrepreneurs. When you are getting in early, you look at the entrepreneurs. You look, I personally look at the person who's leading. My thoughts usually go towards that. Then second thing, what product are they making? Uh, if it is feasible, I have my technology background, I have my marketing background. So all these are personal judgment calls. So I see the investor, I see the entrepreneur, I speak to them, we just go on discussions. It's like if we hit up, I mean, it sounds good, then we move to the product, what they actually want to do, if there is a business plan. So I focus on the entrepreneur and their efforts on building what they are building.
Mhm.
So
N-
efforts can be shown in so many ways. If you have documented your entire process, if you have a documented business plan. So I speak to so many entrepreneurs, they'll come to you, okay, I want to raise money, I have an idea, this is what the idea is. And when you tell them, okay, do you have it written on a pitch? I mean, do you have a pitch deck? No, I don't have a pitch deck. So then the next step is somebody will say, okay, I have a pitch deck, but they don't have a business plan. So you have to understand how they are going to create business, how they are going to generate revenue for it. What are the revenue opportunities? So in the beginning, business plan is very important, which I personally feel. So every entrepreneur who I mentor, I usually see their efforts they are putting in to build the thing. So are they putting in the efforts to understand the business plan?
Mhm.
I tell everybody to write their business plan, not for the investor, but for themselves if they are just starting a new business. Uh, I'm seeing
Yeah,
some
so
message.
no, what I was trying to ask was, see, in our community, SIT community, there are a lot of startup companies. Okay, so during SIT chat like this, many of them come and present, and many of them need investments, right? But most of the cases, the idea itself is not robust. You know, there is no rocket science to make out, but they would have engaged the guys who would do the pitch deck, and they also would charge a couple of thousands to really prepare the pitch deck. And that pitch deck is really not that solid at all. What kind of why do you think such a thing happens in the market? Is it because the guy who's making the pitch deck only wants to do it for the sake of selling his service? Because he also should be knowing that, right? There is no product, there is no market, and there is no clarity as to what the product is, but still pitch deck comes out. What is the reason for that? Because these are all the reasons why the 80% get generated, right, in the entire story.
There are so many reasons for the failures. It can be lesser money, it can be no money, it can be disagreement between the co-founders, can be anything. All right. So that 80% failure is basically it can be driven by a number of things. Maybe some new government policy, maybe some new competition, n number of things. But what works is usually okay, so I'll give you another perspective. So when it comes to investment uh, into a startup, startup doesn't understand where the money is coming from and why they are giving you the money. Every investor primarily gives the money as an investment to generate returns on it. All right, be it an individual angel investor or be it a VC company. uh, Interestingly, by the when it comes to VC company, VCs are not investing their own money. It's not their own capital. All right. VC basically takes money from some other limited partners, who can be some high net worth individual people, HNI, so some big or a family office, so somebody who has a lot of money. The VCs go to those people, they tell them that this is our thesis, this is where we are investing. So you give us the money. So when somebody is giving them the money, these people are promising a return to the actual investor, the limited partner. Now, to generate a consistent return, they have to invest in the companies who are actually generating some good valuation, who can generate some good exits. So every person who's evaluating your company, they are only looking on how they will be able to generate returns from this company. That return will happen only when this company goes for the next round of funding. All right, either it will be a next round of funding or public. Public is a long-term game. It's not like a 2 year or 3 year. But in the next 2 to 3 years, you can always raise for the round of funding, and the investor can take a partial exit or a complete exit based on how they want. So investor is putting in money to generate returns. If as an investor I see a company and I feel that this company cannot generate substantial returns or won't be able to generate the next round of funding, then there is no point of me investing. That money is almost lost.
Okay.
Namrata, I see you
Yeah,
have a
Namrata has a question
question.
here. She has noted down what kind of ITR form does an angel investor file? And then we come to you, Manish. What
So
kind of ITR form does
you usually file your own ITR in the same way. These are investment, there are capital gains. These are short term, or these are treated as long term or short term capital gain solutions. So same format, it falls under the capital gain category. The new rules basically changed a lot of things. We'll have to take a separate discussion completely for the actual ITR on what are the discounts, how it is being evaluated, the long-term capital gain, the short-term capital gain. But mostly it falls under the same category.
Yeah,
Long-term
see,
capital gain or short-term capital gain. These are all unsecured securities. Securities, yes.
yeah, Tushar, if you look at the mutual funds, you can find out each fund how it is performing in the market, right? Now, in the case of angel investment funds, is there something like that available too? Can somebody see how they are performing?
Uh, See, the data is not public. So when it comes to mutual funds or the regular stock market, the data is public.
Mm.
So everything they are sharing with everybody, what is happening, what is not. So when it comes to a private limited company, the data is not public.
Mm.
So you will know only by the exits the company make, or the for future investment the company raise, on how your performance is. All right.
No,
So
if somebody
if
had to
there is a
decide between two angel funds where to invest, right? What would be the criteria?
choose the one which is investing into the kind of companies you like. So, for example, there is a Modi ji recently announced investment into space tech. So, if that is an interesting opportunity for you, if you feel that this has a potential, you invest with VCs who are into space tech. Not every VC will be into space tech, or not every fund will be into space tech.
Mhm. What is
So,
the difference
because
between a VC and the angel fund?
uh, by government definition, both are category one alternate investment funds. One is an angel fund, one is a VC fund. Minimum criteria, Namrata, this will answer your question as well. Minimum investment from an individual angel to the pool is 25 lakhs over the period of 5 years. You can choose how you divide. And from the angel network to the company is also 25 lakhs. You have to invest at least minimum of 25 lakhs to any company you are investing in.
And what about
Uh,
VC? They don't have any rules.
so VC, no, they have higher rules. So VC has a 1 CR check minimum. So you have to invest 1 CR in the fund minimum to be a part of the VC fund. So the rules change a bit. Angel fund is for more people who are not investing with a lot of capital.
Mm.
All right. So if you have a
But again, more
smaller
risky, right?
capital,
Angel must be more riskier
uh,
than VC, or is it the same?
it's the same. I mean, it's the same. So angels are basically investing. These days, there are so many overlaps. So
Okay.
if an angel fund is investing, a VC company is also investing, both are investing in the same company, both are getting similar returns.
Okay, okay, okay. Yeah,
Just
Manish,
the
over
check
to you.
size differs.
Yeah, please ask your question. Please go on, Manish.
Yeah.
Yes.
Introduce yourself first.
Thanks, Dinkar. Tushar, myself, Manish, and my company is about doing that precise assessments. Actually, I run an assessment platform. My question is this, as you said, this one in the mutual fund and AIF is similar but bit different. So when I invest in the mutual fund, I don't have any option to choose a company where do I invest. That is decided by the fund manager. So here actually in AIF, I choose the company where I have to invest, isn't it?
So you say yes or no to the deal flow. Okay,
Uh,
so there is a continuous deal flow which a fund is looking into, and they are choosing, let's say, to invest 5 companies. You can choose to say yes or no to each company. All right. Like I said, mutual fund is basically doing a lot of things on the public company. So a lot of data, a lot of information there. So the compliances are of course different. It's properly tracked because all these things are being traded in a stock market, in a proper regulated market. For the startups, all these the shares are not being traded in a regulated market. So everything is basically behind uh, I mean, a concrete wall kind of, so or a properly translucent wall. So you don't get a lot of information on how these companies are performing over the period of time. That is why there are rights where you say that, okay, if we are investing this much capital, we want a director position, or we want, I mean, a board of director position. We want these rights to have. We want to say yes or no to your new investor. So you can always negotiate on these things.
Okay, okay, thank you. I have other questions too. That
Sure.
I mean, for the funds you manage actually, right? Can we know that what is the size of the funds that you manage and the
So
number
we
of the companies and
right. So
what sectors you support? And if we have to pitch you, how can we approach you?
you can always approach me in the group. So the fund which we are building, we are still building. We have a group of somewhere around 70 investors from Jammu Kashmir. We have been doing these kind of awareness programs because that's a state where nobody understands or nobody has the opportunity of learning about angel investments. So we have been running some programs. The fund is something of a recent update. So we recently went on the started going on the fund route. We have secured our partnerships. We are looking into companies to invest into. We are in due diligence of 2 companies right now. I think I shared it in the group as well for one company. So we are still in the process. Our thesis is mostly towards agriculture or agri-tech products, D2C or commerce products, and technology products, because we have some good number of people who are experts into these fields in our group. So it's easier. So it's like we have a group. If there is, let's say, an agri-tech company, we ask some expert who are in the group or some advisor that this is the company we want to invest in. What do you think about it? That's what we have a process right now. We also have a board of people who are looking into these companies to choose to invest. So it's not we are not doing it in a fund manager way where there is only one person. So we are doing it in a democratic way because everybody is new. So everybody is a first time investor. These are all top business people from the region, but they have a lot of assets in terms of real estate and other investments, but nobody has invested into startups. So they are also learning on how to do that. That is what we have been doing, and that has been motivation behind this session as well. When we had a discussion last week, so because I have been doing these sessions, so I was told that why don't we do it for everybody in the group? So, and I agreed.
Okay, thank you. And one more supplementary question, that what could be the maximum fund size actually, right, for a particular company from your angel network fund?
So we are uh, looking to invest somewhere around 25 to 50 lakhs per company.
Okay. Okay. Thank you. Thank you.
Any other question?
Yeah. So, first thing is the interest is something which is very high. I think you really kindled a lot of interest. Everybody must be quite introspecting what could be done and how it
I
could be done.
hope my presentation was worth it for everybody.
Yeah,
I hope
absolutely,
I was
absolutely,
able to answer your questions.
absolutely. And for the SIT company members, there are companies or startups here. Uh, what would be the right way? That means because we have got multiple people who have either been in the program as investors, or they've been in the program as incubators or accelerators. So accelerator also coming from the investment perspective. They talk about trying to bring in
See,
investors, and there are people.
it's a process. It's a process when it comes to building your company without a lot of funds. So I personally believe, so if somebody has an idea, they should approach incubators. All right, they should not approach angel investors if you just have an idea. Okay, so one day you woke up with an idea and you want to work on it, approach the incubator of any college, any private incubator or any government incubator. There are so many of them. So you can approach any incubator and start from there. Don't start approaching, just don't create a pitch deck and start approaching the angel investors.
Uh,
You won't find success unless you know your people, you know somebody who wants to invest. And in the beginning, that will be the best ways you raise from your family and friends. You don't go to angel funds, you don't go to VCs. I mean, you won't get the opportunity from them, you won't get the eyeball. So best way is to go to an incubator, start from there. So once you are, so there are stages. So once you are past incubation stage, you have created something. All the incubation funds you will get. So government has a lot of schemes for incubation. So you will get the funds from there. So once you are beyond the initial point that you have an idea, now you have an MVP, then you go towards accelerator. And accelerator will also give you the right funding plus the right network. So if you cross both these stages, then you have credentials. Then if you go to any angel investor, they will be more inclined to say yes,
so you
because
mean
it will show your effort.
Yeah, you mean the MVP should be done, PMF should be done, and then possibly also there should be a kind of a business model where you are at least generating a positive bottom line, or have a plan to generate positive bottom
Right.
line. One of the two. Only then it makes sense, right?
Right. See, all these are individual, what do you call, perspective. I'll give you an example. A friend of mine, one of my batchmates, uh, he he was working with the company for a long time, and he is an expert developer. So he was working with the company. He had some good equity there. Uh, Eventually, that company was bought over by Adani Group, not for 100%, but a majority share was bought over by Adani Group.
Mm-hmm.
So he decided that I'll start my own company.
Mm.
So he started raising a 2 crore equity funding.
Mm-hmm.
Okay. They were like, their team was fantastic. So it was a drone company. Their team was amazing. They had designers from Tejas as well in their team.
Mm.
Fantastic team. They wanted to raise 2 crores.
Mm.
43. I don't know what 43 is, but they wanted to raise 2 crores, and in 4 months they ended up raising 300 crores.
300. Oh,
I mean, they got a commitment of 300 crores from
Yeah.
another company in 3 months, 3 August to December, 3 to 4 months time. They got a commitment of 300 crores from another company. So that was primarily because their experience was fantastic. The team was amazing, and by their past experience, everybody was able to judge that they will be able to build this company like they are saying. So they were applying for the right licenses, they were doing all the right things. So these are examples which happen. So you don't know, uh, if you don't have an experience, if you don't have a background of these things where somebody can judge your skill set of building a company,
Yeah.
then you have to go through the grind. So you have to go through all the process. I know so many people who start raising fund but end up not raising anything. Uh, because they are not trying to approach it properly. They have to go to incubator. Incubator will tell them their idea is good or bad in the beginning itself.
Yeah.
Then
Yeah.
you go to the accelerator. If you cross these two stages, then you are investable. So the whole idea of somebody investing money is to be an investable company to get money from the investor.
Yeah.
So
Yeah.
if you are not investable, nobody will invest.
Investable. Yeah, that's a good good idea. Good
Uh,
word. Yeah.
right.
So, anybody else have any question, any comment to make? Tushar, what is this 43? I say you said no, Namrata. What is
Namrata
43?
said 43. I wanted to ask the same question.
Sorry, there was a kid in my home.
Okay.
It randomly typed some.
Oh, okay. It is not your doing. Okay.
I am running a venture studio which is called X42. So I thought maybe it's a coincidence or probably something. So, but probably there
Okay.
is a connection.
Super. So, Tushar, thank you very much. Thank you very, very much. And for all the others, if you can switch on your cameras, we'll take a snap of all of us together and then we can
Thank
end
you,
the
Abhishek.
discussion. Whoever wants to switch on the cameras, please switch on your cameras. And I just take a screenshot and then thank you very, very much for a wonderful session, Tushar. Very, very enlightening, very engrossing. And I'm sure at some point of time we will get back to you with more requests for
Sure.
helping us out. Thank you so much. Thank you. Bye-bye.
All right, Ji. Take care. Bye bye. Thank you very much.